Welcome back. You're watching the commodity trade. Let's put the focus on the commodities complex. Vandana Hari, founder at Vanda Insight, joins us on the show from Singapore. And we also have Prathamesh Mallya, chief analyst at Angel Broking, who joins us to give us an MCX viewpoint as well. Vandana, let me come to you first. This week has been rather volatile for Brent and WTI both. And essentially, after the EIA data was reported and we saw a wind down, which was below expectations, and gasoline pile up also. The fall was quite sharp. I mean, 3.8%, 3.7%, and typically we've seen on API and EIA data this kind of volatility that has continued for the last month and a half. What's the very near-term outlook on both these?
Yeah, it was a bit of a shock for the market this week to see gasoline inventories in the US building up instead of drawing down, because typically April to September is the high demand season for gasoline. You know, it's the driving season in the US. And what the markets had been expecting was a drawdown in gasoline and a drawdown in crude stocks as well. So the past several months, consistent build in crude stockpiles in the US has also been pressuring the market. Now, as expected, the crude stocks drew down, but obviously gasoline was a big surprise and quite an upset for the market bulls. Now, going forward, we are in the second quarter, which is expected to continue seeing a drawdown of crude inventories in the US. So that's what the market is factoring in right now. That refining rates, which were pretty low in the first quarter of this year in the US, which led to a pileup of crude stocks, should start ramping up in the second quarter in preparation for the high demand season. So those are the expectations. But of course, this is just small fraction of the market observations. The market is very heavily also focused on what OPEC, non-OPEC cuts are doing, what the compliance is doing, what the plans are with regard to the cutbacks after June, as well as what's happening to stocks globally. The US is, again, a fraction of the global stocks, but because the data on the global stocks is not as frequent or as transparent as the US, the market zeroes in on the US data.
Right. Vandana, it's interesting you spoke about compliance, because that report was also very interesting, the MOMR report of the OPEC. And while there is the secondary reporting and the primary, the self-reported number of countries, Saudi Arabia was a little interesting because the data was a little divergent, because the secondary data said that there's a build-up, while the nation itself reported a wind down. So what is the actual number to go by? Because of the overall basket in OPEC, Saudi Arabia is basically where it is hinged, where the movement is hinged and predicated from, right?
Yeah. See, when we're looking at what OPEC is doing with regard to its cuts, there's a lot of data that you can go through what the countries are producing, what their compliance rates are, what they're using internally, what they're exporting. Some countries say, like Saudi Arabia, increased its March production versus February, though it's still within its quota, but it said that we didn't export as much. So what I would urge you and your listeners to look at, because there's a lot of noise in the markets, the important thing to look at is overall what the compliance is. Unless you want to really you want to analyze the details of the countries, you just want a big picture of the market. You should look at the overall compliance. The overall compliance of OPEC has been surprisingly good. It started with a very strong compliance in January, and it's been consistently improving. There's a little bit of concern on the non-OPEC side, who are the 11 countries that are cutting about 600,000 barrels per day, half of what OPEC is cutting, which has not been as good as OPEC compliance, but that is improving as well. I think the market this is all baked in now into the prices that you see today. The market is now assuming that OPEC is committed, that compliance will remain good. The question has now turned to what they do with the agreement post-June, because the current agreement expires in June. And again, on that front as well, the market is factoring in largely that they will have to roll over, because what we've seen through the first 3-4 months of the cuts is that global inventories haven't really declined as much as had been expected or as OPEC might have hoped for. And I think very quickly we should also look at a big bearish shadow being cast on the markets from US production growth. So US production has been consistently rising for the past few months. There's still a question mark on whether it'll be a big enough boost to neutralize OPEC, non-OPEC cuts or not. I think that is right now keeping the market on its toes.
Right, let's also get in Prathamesh into this discussion. Prathamesh, if you can share your near-term targets on crude, because in this week we've seen some kind of a weakening, especially by that 3.8% cut. But where do you see the bottom in, say, possibly for the time period going into the next meeting?
Before the next meeting, we feel that near-term correction looks very likely. We are expecting M6 crude prices to possibly go down lower towards 3,220 mark. A lot of ifs and buts in crude oil markets as such. Inventories remain very high when crude oil production is increasing. On the other side, you have compliance of OPEC, which is something really creating jitters in the market. So I feel the near-term targets for crude would be around 3,200 mark in the domestic markets. And in WTI terms, we are expecting possible $2 a barrel fall in international markets.
Right. Prathamesh, let's continue with the metals also. I mean, after the continued string of weakness that we saw in the latter half of the week, in fact, towards the fag end, we've seen some recovery play out on zinc, on copper and aluminium as well. Do you think that the near-term bottom has been attained, at least for now, and could we look for more upside? If you can share targets here.
In the entire base metal pack, I feel lead and zinc would still be under pressure, and it would further go down by 4 rupees, 5 rupees in both the metals. But aluminium is something which stands very good out of the entire pack because of something production cuts which would be happening in China possibly this winter. So out of the entire base metal pack, aluminium would be the best bet if you want to bet on it. To be on the long side for target higher towards 128. But if you're looking for a near-term strategy, I would pick copper as one commodity wherein I would trade, but if you're looking I would be on the buy side for copper. If you're just looking for near term, the buy side would be around 363, which is hovering at current mark. The stock would be 360 for target higher towards 370.
Right. Vandana, what would your near-term target on crude be? And also, if you can speak to us a little in detail about Contankno, because now, as you said, we are in the peak usage season in the US, and we've seen shale production also go up. I mean, I think the last I checked was 662 rigs, but this is vastly different from what we saw last year. So, you know, a word on the cost of storage at this point, the value associated with it, and also the shale outlook, and your target as well.
So let me start with what is the outlook for prices. We have seen in the past few months, pretty much since the start of this year, Brent rose to, there seemed to be a resistance around $56 for Brent. And in the past few weeks, we've seen it swing between a low of 50 and a few cents to 56 and a few cents. And typically, WTI has been roughly around $2. It went to as much as $3, but it seems to have settled into $2 below Brent. I think going forward in the next few weeks, there'll be basically the contest will be between two major opposing forces. The market will continue to look at what OPEC plans to do post-June. I think the attention is definitely going to shift there now, not so much worried about their compliance. I think the market is quite satisfied about that. And is that really resulting in a drawdown of stocks? So that on the one side. On the other side, which is the bearish shadow that I mentioned earlier, that is being cast on the market, all eyes will be trained on how much U.S. production is growing. Now, U.S. production grew phenomenally between 2011 and 2014, almost 1 million barrels per day growth year on year. For the first time in many years, last year, it actually fell. And this year, it's back in the growth trajectory. And as I mentioned earlier, I think the question is going to be, you have on the one hand, nearly 1.8 million barrels per day of cuts. And what amount of U.S. production growth will it take to offset that? So anything, let's say more than 500, 600, 800,000 or 1 million barrels per day growth even, I wouldn't rule that out. There is immense amount of funds that are going back into the shale properties in the U.S. The debt environment of the shale producers has improved. So if that number from the U.S. production is big enough to offset what OPEC and non-OPEC are taking away from the market, we could see prices, maybe perhaps even going back below $50 a barrel. But until it remains kind of evenly balanced, I see more of a 50 to 55 range for Brent. And you mentioned stocks. Now, again, stocks are still sitting in the OECD countries, where it's measurable. There's stocks in Asia and China, of course, which, we really don't have any good, clear data on that. But as far as the measurable reported stocks go, they're still sitting well above 5-year average levels. OPEC says that it wants to continue its cuts until they come back to the 5-year average range. My argument to that is that I don't think that's the end. It's just the beginning, because after that, if you have OPEC putting back that 1.8 million barrels per day into the market, and you have an increase in U.S. crude production, and demand is not growing that well in the world, the world could slip right back into a glut. So basically, I think OPEC needs to continue the cuts, the way I see it, even beyond 2017, quite likely into 2018 as well.
All right, Vandana, we're going to leave it at that. But thank you so much, Vandana, as well as Prathamesh, for joining in and giving us your insight about crude, and also Prathamesh for giving us your near-term targets as far as the base metals complex is concerned. With that, that's all the time that we have in this edition of the Commodity Trade. Thank you so much for watching.